A foam clog discovered on a Caribbean fishing trip turned into a $6 billion sensation, then almost vanished overnight. Crocs was supposed to be unstoppable, with an IPO windfall and a cult following. But beneath the quirky charm, supplier secrets and reckless expansion triggered one of retail's fastest collapses. How did comfort become catastrophe? And can Crocs escape the cycle? Or is another crisis already brewing? Scott Siemens, Lyndon Duke Hansen, and George Bodecker Jr. did not set out to launch a global footwear phenomenon. In 2002, the three friends were on a fishing trip in the Caribbean when they stumbled across a peculiar foam clog made by a small Canadian outfit named Foam Creations. The material, Croslite, felt nothing like ordinary rubber or plastic. It was feather-light, molded perfectly to the foot, and resisted slipping even on wet boat decks. The trio, each with a background in business or engineering, recognized something rare, a material with the potential to solve problems for boaters, gardeners, and anyone who spent long hours on their feet. Back in Colorado, they moved quickly. By the fall of 2002, they had secured exclusive rights to Croslite and arranged for the first 200 pairs of their new shoe to debut at the Fort Lauderdale Boat Show. The response was immediate and overwhelming. Every pair sold out within hours. Word spread among boaters and nurses, people who valued comfort over style, and soon demand outpaced their modest production capacity. The founders saw more than a niche product. They envisioned Croslite as the foundation for a new kind of footwear, one that was functional, durable, and unapologetically different. To secure the supply chain and protect their advantage, they negotiated the full acquisition of Foam Creations in 2004, bringing both the material and its inventors under their control. This move gave Crocs a rare level of command over its core technology. But it also introduced new tensions. Canadian engineers, proud of their technical achievement, sometimes clashed with the aggressive expansion plans coming from Colorado. The founders pushed for rapid rebranding and mass production, eager to transform the quirky clog into a household name. As the first shipments rolled out, Crocs' reputation grew quietly. Nurses, chefs, and gardeners praised the shoe's comfort and practicality, while skeptics mocked their odd appearance. Yet the founders remained undeterred. They believed that Croslite's unique properties would win over anyone willing to give the shoes a chance. In the beginning, Crocs was not a fashion statement or a meme. It was a solution born from a chance encounter and a willingness to bet on the power of a single, strange material. On February 8, 2006, Crocs entered Wall Street with a splash, raising $208 million in its initial public offering, at the time the largest U.S. footwear IPO ever recorded. The company's revenue for that year soared to $354.7 million, more than tripling from just 12 months earlier. Suddenly, Crocs wasn't just a Colorado upstart with a quirky clog. It was a public company, flush with cash and under the glare of investors demanding growth at any cost. The influx of capital transformed every corner of the business. New factories were commissioned across North America, Europe, and Asia. Production lines ran day and night. Crocs hired aggressively, swelling its workforce to thousands. International expansion became a mandate, not an option. Executives chased shelf space from Tokyo to Berlin to Sao Paulo. The company's leadership, emboldened by Wall Street's appetite for novelty, began rolling out hundreds of new colorways and styles. Retailers clamored for more, and Crocs answered by flooding the market with product. The pressure to deliver explosive growth quarter after quarter changed the company's DNA. Decisions that once favored caution and incremental progress gave way to bold bets and rapid-fire launches. marketing budgets ballooned. Partnerships with Disney, Marvel, and the NFL promised to turn Crocs into a household name. The original clog remained the cash cow, but the push to become a lifestyle brand was now in full swing. The public markets, though, demanded more than comfort and quirky charm. Shareholders tracked every earnings call, every shipment, every hint of slowing demand. Analysts issued glowing reports, projecting the company's valuation into the billions. Inside Crocs, the sense of invincibility grew. With more than $200 million in fresh capital, the company seemed unstoppable, its future limited only by the boldness of its ambitions. Yet the same tidal wave of money and momentum that fueled Crocs' rise would soon test its limits, exposing vulnerabilities that had once been easy to ignore in the rush to conquer the world. Crocs didn't just sell shoes, they became a worldwide sensation. By 2007, the foam clog was everywhere, on the feet of school kids in Tokyo, chefs in Paris, and even runway models in New York. Celebrities who once scorned the brand started wearing them in public. Jack Nicholson sported a pair at a Lakers game. Fashion icon Heidi Klum was seen in pink Crocs at the airport. Even Mario Batali, the celebrity chef, made his signature orange clogs part of his personal brand. The shoes showed up in hospital wards, on construction sites, and in viral internet memes. Crocs even landed guest spots on late-night TV and featured in Saturday Night Live sketches. Retailers scrambled for inventory, and Crocs responded by launching a dizzying array of colors and limited editions. The classic clog became a blank canvas for self-expression, decorated with gibbets charms, customized with paint, or worn mismatched for effect. Children wanted them for the playground. Parents bought them for comfort. They crossed generations, cultures, and continents. Mania had taken hold. Brand partnerships supercharged the hype. Disney's Mickey and Marvel's Spider-Man appeared on Crocs, turning them into collectibles. The NFL and NCAA signed on, putting team logos on the foam. By the end of 2007, Crocs' operating margin was nearly 60%, numbers that rivaled Silicon Valley's hottest tech firms. The company boasted over $800 million in annual sales and a valuation that stunned Wall Street. Everywhere, the message was the same. Crocs had become a badge of comfort, rebellion, and belonging all at once. The odd-looking clog was no longer just a shoe, it was a pop culture icon. The business world watched in disbelief as Crocs seemed to defy the rules of fashion and retail. But in the shadows of this global craze, the seeds of fragility were quietly taking root. Crocs' leadership, flush with cash and chasing the next big wave, set out to multiply its product lineup at a dizzying pace. By the end of 2007, the company offered more than 250 distinct stock-keeping units, each a unique blend of color, size, and style. The original clog was joined by sandals, boots, flip-flops, and even attempts at sneakers. No opportunity seemed too small. Executives inked deals with Disney, Marvel, and the NFL, stamping familiar characters and team logos on the foam. Licensed partnerships promised instant hits and easy shelf space, fueling a belief that Crocs could become a year-round, all-ages lifestyle brand. The logic was simple. More choices meant more sales. Retailers eagerly ordered new colorways and limited editions, convinced that every fresh drop would fly off the shelves. Product managers, emboldened by past successes, pushed through dozens of new designs with only cursory demand checks. The company's systems tracked inventory at the stock-keeping unit level, but as the catalog ballooned, oversight grew patchy. Each new partnership, each special release, added more complexity to the supply chain and more inventory to manage. Behind the scenes, a quiet dependence on a handful of bestsellers shaped the bottom line. Despite the explosion of options, nearly all profits still came from the classic clog. The vast majority of new stock-keeping units, seasonal colors, fashion experiments, and branded tie-ins barely moved the needle. Yet the pressure to maintain momentum drove Crocs to chase every trend and retailer request. With so many products in play, the company's manufacturing and logistics teams struggled to keep up. Minimum order sizes for new stock-keeping units meant warehouses filled with slow-moving stock, especially in less popular colors and sizes. As the catalog grew, so did the risk. A single miscalculation could leave millions of dollars stranded in unsold inventory. The seeds of overreach were sown not in a single bold move, but in hundreds of incremental decisions, each one a bet that the world would never tire of more Crocs. Inside Crocs warehouses, the mood was growing tense. By late 2007, inventory had ballooned from $35 million to more than $180 million in a single year. Pallets of unsold shoes, many in obscure colors and unpopular sizes, crowded distribution centers from Colorado to China. Operations staff warned that forklifts could barely navigate the aisles. One logistics manager later recalled, "You couldn't even find the forklifts. There were that many unsold boxes stacked to the ceiling." Beneath the surface, a more subtle risk lingered. The Croslite resin, the secret behind Crocs' comfort, came from only 2 authorized suppliers worldwide. Internal documents flagged this as a single point of failure. Any disruption, whether from a plant outage, a labor dispute, or a shipping delay, could halt production overnight. Yet the leadership, focused on chasing demand, saw supplier secrecy as a competitive edge rather than a vulnerability. Contingency plans were minimal and rarely discussed outside closed-door meetings. The pressure to keep up with demand forecasts led to ever larger manufacturing orders. Minimum batch sizes meant that even experimental styles and niche colorways arrived by the truckload. Warehouse staff, already stretched thin, struggled to track slow-moving SKUs. Inventory management systems, designed for steady growth, buckled under the complexity of hundreds of new products. Internal warnings about excess stock and supplier risk circulated through emails and meetings, but optimism prevailed at the top. Executives clung to the belief that every new shipment would find a buyer. As warehouses filled, the cash drain accelerated. Millions of dollars were locked up in unsold stock, tying up capital that could not be recovered quickly. Storage costs soared. Operations teams pleaded for restraint, but their concerns were lost amid the noise of expansion. In the background, the company's entire supply chain rested on a fragile foundation, hidden from public view, but well known to those managing the day-to-day chaos. Investor confidence, once unshakable, began to waver as the scale of the inventory problem became impossible to ignore. In April 2008, shock hit investors. Crocs issued revised earnings guidance, warning that sales were slowing and unsold inventory was piling up. Overnight, the company's stock price collapsed by 30%. Within months, shares that once traded at $74, valuing Crocs at nearly $6 billion, were worth barely more than $1. The market's faith vanished in a single quarter. Financial filings revealed the full extent of the disaster. Revenue fell from $847 million in 2007 to $721 million in 2008. Profits did not just shrink, they swung to a loss of $185 million. The company's operating margin, once the envy of Silicon Valley, evaporated. Warehouses remained stuffed with millions of unsold clogs, each box representing capital that Crocs could not reclaim. Retailers, burned by overstock, slashed orders, and demanded steep discounts. Then came the rarest warning in corporate America. In its 2008 annual report, Crocs independent auditors issued a going concern statement. The language was blunt. There was substantial doubt about Crocs' ability to survive. For a brand that had been a Wall Street darling just months earlier, the public alarm from auditors was a gut punch. The warning sent ripples through the business press, but inside Crocs, it landed like a funeral bell. Executives scrambled to reassure investors, but the numbers spoke for themselves. Panic spread through the ranks. Emergency board meetings debated which product lines to axe and how many jobs to cut. Some directors quietly floated the idea of shutting down entire divisions. PR teams clung to outward optimism, even as internal emails revealed confusion and fear. As cash reserves dwindled, cost-cutting began. Crocs laid off more than 2,000 employees, about one-third of its global workforce. Factories in Canada and Brazil went dark. Distribution centers closed, leaving behind vast, empty warehouses. The company's global footprint, once a symbol of ambition, now looked like evidence of hubris. Throughout the collapse, it was the auditors, not the executives or the markets, who delivered the harshest truth. Their warnings stripped away the last illusions of invincibility. Crocs had gone from Wall Street marvel to cautionary tale in less than a year. John Duerden, a veteran of Reebok, stepped into Crocs' battered headquarters with a mandate to stop the bleeding. His first orders were simple and stark: shutter excess factories, slash bloated product lines, and clear out the mountains of unsold inventory clogging the company's balance sheet. The changes were swift and painful. Hundreds of jobs were cut, and operations were scaled back to the core. But within a year, Crocs clawed its way back into the black. Then, in 2013, Blackstone provided $200 million in cash, buying time for further restructuring. Stores closed, non-essential projects were shelved, and the company's footprint shrank to something manageable. These triage measures did not spark a revival overnight, but they gave Crocs what it desperately needed: a chance to survive and regroup after the free fall. Andrew Rees arrived with a mandate that favored discipline over dreams. His team pored over years of sales data, discovering that less than 20% of Crocs' product lines drove more than 80% of profits. Hundreds of slow-selling stock-keeping units disappeared almost overnight. The focus returned to the classic clog, and for the first time in a decade, the company's numbers told a story of restraint. By 2021, Crocs' revenue surged past $2.3 billion, fueled by a pandemic that made comfort king. But with recovery came familiar temptations. In 2022, Crocs spent $2.5 billion to acquire HeyDude, a move that loaded the company with new debt and revived old debates about overreach. Meanwhile, critics pointed to the Souls United recycling program, questioning whether Crocs' green promises matched reality. Even as profits climbed, the risks of past excesses lingered, leaving the future uncertain. Today, Crocs sits atop $2.8 billion in annual revenue, proof that fashion's tides can shift overnight. But as trends accelerate and supply chains grow ever more fragile, the real risk isn't another quirky shoe. It is how quickly hype can outpace substance. The next collapse may be just a viral moment away.